Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Seema Mody, in today for Bob Pisani. I'm joined by Dave Nadig, Managing Director of ETF.com, and John Davi, Founder and Chief Investment Officer at Astoria Portfolio Advisors. Now, guys, markets are staging a modest rebound from Friday's losses, but remain on edge after inconclusive trade talks and weakening global data. Plus, with the odds of a rate cut later this month creeping steadily higher, the hunt for yield is still going strong. John, what are some of the best dividend plays right now?
So, I mean, broadly speaking, in my personal view, anything like stock dividend yield, bond yields, they're all pretty much crowded, expensive, vulnerable, if I'm being honest. Now, when I look at the 10-year, right, it's yielding 1.75, I think what a lot of investors do is they say, okay, I like this high dividend yield ETF, it yields 3-4%. That's great, but just keep in mind that that carries a lot of risk, okay? Like 10-year is a risk-free asset, and now you're going into the stock equity space, which carries a lot more volatility. If you must own a high dividend yield ETF, what I would say is load it up into a portfolio construction tool, load it up into a risk model, find out what your sector weights, what your exposures are. Three that I'll highlight is, and I'm not advocating these, but I just want to alert the viewers to the risks, okay? HDV, 21% energy stocks. It's a lot of risk for me. VYM, it's got 18% in banks, okay? DVY, it's got 40% in banks and utilities. So in my personal view, what we use is DGRW from WisdomTree. This is more of like a dividend growth, high quality ETF. So it screens for companies with above average ROE, ROA, and above average earnings. And the idea there is that strong fundamentals can eventually lead to high dividend growth.
So John brings up some interesting points, Dave. Should you look to the traditional sectors like utilities and real estate for yield, or transition into banks and energy, other sectors that may offer a yield not as high as real estate and utilities, but there is a yield?
Yeah, I mean, I think that may be a better play. If you look at some of the funds that have very attractive headline yields right now, like the Global X Super Dividend Fund, yeah, that may have a 7 or 8% yield on it, but it's actually been a terrible performer, I think, for a lot of the reasons John's talking about. Dividends as sort of a proxy for cash flow, as a proxy for quality, can make a lot of sense. If you look at First Trust Dividends Fund, FDV, this year, one of the biggest sets of inflows we've seen, it's got like a headline yield of 3%, which is very market-like. Yeah, it's beaten the S&P handily. So I think thinking about dividends not so much for the coupon yield like you would for bonds, but as a proxy for quality is probably a better play.
What about looking overseas? Emerging market debt on average, a yield of 6%?
Yeah, I mean, this has been one of John's go-tos. You want to talk about emerging markets dividends?
Yeah, I mean, largely speaking, we like EM, we're overweighted. I think, most of the US markets are kind of getting to be fair value. So we use EDIV, which is another one of these dividend growers, and it screens out specifically for companies that have stable earnings, stable dividends. So we like that. It trades at a discount to EEM. EEM's like 13 PE. EDIV is like an 11 PE ratio. On a one-year basis, EDIV has outperformed EEM. So it's a little bit of a higher quality EM tilt.
Even though there's yield, there's always that risk with emerging markets, slower growth, and that trade dispute between the United States and China.
Yeah. I look at EM, margin of safety, value. I actually think the U.S. is riskier just because you've had this incredible run the last 7-8 years, and you're trading at a pretty high valuation level. So I kind of think that EM is less risky to some degree compared to the U.S. market.
As to where yields go from here, Dave, we have the European Central Bank meeting on Thursday. We may get another cut deeper into negative territory. What does that mean for the overall trajectory of global rates?
Well, it just means that you're really going to have to be struggling if you're trying to actually live off these, right? The idea is that people living off the coupons from bond portfolios, that's pretty old thinking. At this point, you've got to be thinking about total return. I think we are going to be in a flat to declining interest rate environment. I see no reason that that's going to turn around at all. So what you're looking for is what's going to pop when we get some relief, whether it's Brexit relief or trade tension relief. We need things that are going to rally quickly off those, and that's not going to show up in coupon payments.
So if we do get that relief, do you see the 10-year headed to 2% before the year end?
Yeah, if there's risk on, I would expect yields to rally further.
All right, your top pick in this space?
I think FDV, the First Trust Value Line Dividend Fund, would be the one that I would go to.
Is that the super dividend one?
No, the super dividend one is from Global X, has the big coupon yield, but has been a pretty consistent underperformer.